Welcome to the Radio Revenue Podcast.
Glad to be here.
We are really thrilled to have you with us today because whether you are prepping for a high-stakes finance meeting or, trying to make sense of your own 401k allocations.
Or if you are just insanely curious about how money actually moves around the globe.
Exactly. You are in exactly the right place. Today's mission for our deep dive is to decode a single, honestly, incredibly dense document. We are looking at the newly released 2025 Form 10K from BlackRock, Inc.
Yeah, the definitive SEC filing.
Right. It outlines their entire global operation for the fiscal year ended December 31st, 2025. And listen, understanding this single document is essentially a shortcut to understanding the entire global economy.
It really is. It touches everything.
To kick things off, I need to drop a headline number that genuinely made me do a double take. At the end of 2025, BlackRock was managing $14.04 trillion in assets. Trillion. With a T. To put 14 trillion in perspective for you, if you spend $1 million a day, every single day since the birth of Julius Caesar, you wouldn't even be close to spending a single trillion.
It is a staggering figure, and it's crucial to understand what that actually represents in the market, right?
Yeah, break that down for us.
When we talk about assets under management, or AUM, we aren't talking about money that BlackRock owns itself.
Right. It's not their corporate bank account.
Exactly.
Right.
We are talking about the financial assets that they manage on behalf of their clients, and those clients are massive pension funds, charities, endowments, sovereign wealth funds, and quite frankly, everyday retail investors like you.
People listening right now.
Yep.
Yeah.
But what is truly monumental here isn't just the sheer size, it's the growth rate. They have achieved a 10% compound annual growth rate in their AUM over the last 5 years.
10%.
Right. Maintaining that kind of consistent compounding growth while operating at a scale of over $14 trillion. That is a feat of financial gravity that you just don't see anywhere else.
Okay, let's unpack this, because this $14 trillion pie isn't just sitting in a giant, Scrooge McDuck-style vault somewhere.
No, definitely not.
When you look at the actual breakdown in the filing, how is all that capital actually deployed?
It's heavily diversified, which is really the core of their strategy. Looking at the filing, they have about $7.8 trillion sitting in equity portfolios.
Okay.
Then you have another $3.3 trillion allocated to fixed income, so that's your government and corporate bonds.
Right.
And perhaps most notably for the everyday investor, they have over $5.4 trillion sitting in exchange-traded funds, or ETFs.
Well, looking through this 10K, it's clear they also went on a massive shopping spree in 2025.
Oh, absolutely.
The July transaction with HPS Investment Partners and then the September acquisition of Elm Tree Funds really stood out to me. What exactly are they trying to buy here with these moves?
Well, it looks like a shopping spree on paper, but it's actually a highly defensive strategic pivot. If we connect this to the bigger picture, we are witnessing a fundamental structural shift in global finance.
How so?
They aren't just buying assets, they are buying complex capabilities.
Yeah.
HPS Investment Partners, for example, added $118 billion in fee-paying assets right out of the gate.
Wow.
Yeah, and that heavily positioned BlackRock into global credit markets. And then Elm Tree Funds expanded their footprint as a real estate owner and operator.
So they are moving away from just, tracking the S&P 500 and buying regular corporate bonds.
Exactly. For decades, the focus was on public markets, trading shares of publicly listed companies. But institutional clients are increasingly demanding what the firm calls whole portfolio solutions.
Whole portfolio.
Right. They want direct access to private credit, infrastructure projects, and commercial real estate.
Because it's less volatile.
Partially, yeah. These private markets often offer very different risk-return profiles, and they're generally less correlated with the daily volatile swings of the stock market. Plus, for BlackRock, managing private assets captures significantly higher fee rates than managing traditional low-cost index funds.
Which makes sense.
By acquiring firms like HPS and Elm Tree, they are moving far beyond traditional public equities to capture those higher margins and meet the evolving demands of massive institutional investors. That private markets and alternatives category now sits at a massive $423 billion in AUM for them.
Which brings me to something that honestly shattered my mental model of this company.
The tech side.
Yes. When you hear the name BlackRock, you immediately think asset manager. But reading through the revenue streams in this 10K, it becomes incredibly clear that they are actually a massive technology company hiding in plain sight.
They absolutely are.
They have an entire category dedicated to technology services and subscription revenue. And in 2025, that revenue hit $2.0 billion.
Yeah.
That is up 24% from the previous year. How does an asset manager accidentally build a $2 billion tech business?
It wasn't an accident. It was an absolute necessity. The $2 billion is largely driven by their proprietary investment and risk management platform called Aladdin. Right. It stands for Asset, Liability, Debt, and Derivative Investment Network. Think of it as the central operating system for a massive chunk of the global financial industry.
So they sell it to other people.
Exactly.
Yeah.
They don't just use it internally to manage their own $14 trillion. They lease it out as a software as a service to rival asset managers, major insurance companies, and global banks.
And they are clearly doubling down on that tech dominance. The filing details a major move in March 2025, the acquisition of a company called Preqin for 2.5 billion British pounds.
Which is roughly 3.2 billion US dollars.
And they bought it entirely with cash.
What's fascinating here is the synergy they are creating with that specific purchase. Look at what they already had. Aladdin handles their broad risk management and portfolio construction. Right. And they had previously acquired a system called eFront to handle alternative investment workflows. But private markets, like venture capital, private credit, or investing in a toll road, those are notoriously opaque.
Yeah, there is no daily ticker tape on CNBC showing you what a private startup is worth at 2:00 p.m. on a Tuesday.
Exactly. It's not like looking up the price of Apple or Microsoft on your phone.
Precisely. By integrating Preqin, which is a premier global provider of private markets data, BlackRock is essentially solving that transparency problem for the entire industry.
Always.
They are providing the essential data and risk analytics infrastructure that wealth managers and rival institutions desperately rely on to navigate the opaque world of private capital.
That is huge.
It is. The 10K makes it very clear that they are heavily focused on integrating artificial intelligence, expanding their application programming interfaces, and enhancing cloud connectivity within Aladdin. They are weaving their technology so deeply into the fabric of the financial system that for many firms, unplugging from BlackRock's tech would be like a modern business trying to unplug from the internet.
That is a wild concept. They aren't just playing the game, they are literally leasing the game board and the rule book to all the other players.
That's a great way to put it. But if Aladdin is how they manage the plumbing for the big institutions, how is that technological efficiency trickling down to the retail investor? Because their dominance in the ETF space is just staggering.
It trickles down through scale and accessibility. BlackRock's iShares division is the undisputed heavyweight in the ETF space. In 2025 alone, they generated $527 billion in ETF net inflows.
To make that tangible for you listening right now, ETFs act almost like a highly transparent, incredibly precise shipping container.
Right.
Whether you are an everyday retail investor logging into your brokerage app to buy a target date retirement fund or a multi-billion-dollar pension fund trying to hedge a specific risk, ETFs give you a low-cost, immediate way to buy a basket of assets. You can buy emerging market tech stocks, treasury bonds, or precious metals with a single click.
That shipping container analogy is perfect. ETFs have completely democratized access to difficult-to-reach markets. They provide the intraday liquidity that investors need to make tactical allocation changes almost instantly. And because of their underlying technology and scale, BlackRock has positioned itself as the primary beneficiary of that secular shift in how the world invests.
Here's where it gets really interesting, though.
Oh, I know where you're going with this.
Tucked into this 10K is a massive story about the crypto boom. They have a digital assets category, and looking at the 2025 data, it absolutely exploded.
It really did.
Digital assets grew to $78 billion in AUM. That growth was driven by $35 billion in net inflows, primarily into Bitcoin exchange-traded products, or ETPs, across the US, Canada, Europe, the UK, and Australia, plus a US Ethereum ETP.
Yeah.
They didn't just dip their toe in the water, they basically built a highly regulated global aqueduct for crypto.
The so what for you as an investor here is quite profound. BlackRock is acting as the ultimate bridge between traditional legacy finance and emerging frontier asset classes.
Because before this, crypto was just on the fringes. For years, digital assets existed on the fringes. They were viewed with intense skepticism by institutional finance. By wrapping Bitcoin and Ethereum into regulated, highly transparent ETP structures, BlackRock isn't just reacting to a fleeting retail trend. They are actively institutionalizing it.
They are essentially giving it the Wall Street stamp of approval.
Exactly. They are validating these assets for an entire class of fiduciaries and institutional investors who previously couldn't or legally wouldn't touch them.
Wow.
And we see a similar institutionalization happening with their traditional commodity products. Those saw $25 billion in net inflows in 2025, largely driven by a massive surge in demand for gold exposures.
Right.
So whether it is a digital coin or a physical bar of gold, they are creating standardized, easily accessible pipelines for every conceivable asset class.
It takes a massive, well-oiled engine to keep all these trillions and terabytes moving smoothly.
It really does. Let's pivot and look at the internal engine driving this massive firm. Their people, their corporate culture, and of course, the raw financials. The human capital section of the filing notes, they have 24,900 employees spread across more than 30 countries.
Managing a global workforce of that size requires a very deliberate cultural glue.
Yeah.
That becomes especially critical when you're acquiring other massive firms like HPS Investment Partners and bringing thousands of new, highly compensated employees on board simultaneously without disrupting the core business.
The filing talks extensively about their one BlackRock or one BLK culture. It seems they're putting a significant amount of resources into employee well-being and structural resilience.
They have to.
For instance, they highlight a global mental health ambassador program where employees are specifically trained in empathetic listening to support their colleagues.
That's unique for a finance firm.
Right. They also have highly targeted recruiting initiatives. They detail programs for military veterans transitioning to civilian life and a program for returners,
Which is their term for professionals re-entering the workforce after taking a career break of 18 months or more.
It paints a picture of a company trying to build a very deep, resilient bench of talent.
Well, human capital is their primary asset. The software and the AUM are just the outputs of those 24,900 people.
Let's look at the financial outputs of those people then. In 2025, BlackRock brought in $24.2 billion in total revenue.
Massive number.
Their operating income was $7.0 billion under standard GAAP accounting, which stands for Generally Accepted Accounting Principles. But they also reported an as-adjusted operating income of $9.6 billion.
Right.
Now, one specific detail really stood out to me when looking at how they bridged that gap between the GAAP and the adjusted numbers. It was the circle move.
Ah, yes.
In December 2025, BlackRock took a portion of its corporate stake in Circle Internet Group and contributed it to the BlackRock Charitable Fund. This philanthropic contribution resulted in a $109 million expense hitting their books.
This raises an important question about how we measure the true underlying health of a massive corporation. When a company reports its official earnings to the SEC, standard accounting rules require them to include every single expense, no matter how unusual.
Right, the GAAP rules.
But management teams often provide as adjusted or non-GAAP numbers to show investors what they believe is the actual sustainable run rate of their core business.
So they are basically saying, ignore this one-time event if you want to understand our actual day-to-day profitability.
Precisely. The $109 million charitable contribution of that Circle equity was a substantial philanthropic move, but it is a non-recurring event. It doesn't reflect the daily cost of running their asset management or technology businesses.
Got it.
Similarly, their 2025 financials included a $39 million restructuring charge related to severance and deferred compensation as they reorganized certain parts of the firm.
So you pull those out.
By backing out these one-time charges, along with certain acquisition-related costs, management calculates an adjusted operating margin. And for 2025, that adjusted operating margin sat at a highly profitable 44.1%.
That is incredibly high.
It is. And understanding these adjustments helps you, as an analyst or an investor, evaluate whether the core engine of the firm is actually becoming more or less efficient over time, completely divorced from corporate philanthropy or one-off mergers.
So what does this all mean when you step back and look at the sheer scale of this operation? We have a $14 trillion behemoth deeply embedded in public equities, private credit, commercial real estate, digital assets, and the literal risk management software running their own competitors.
It's almost unfathomable.
But that level of scale comes with an incredibly heavy burden. Segment 5, our deep dive today, focuses on the regulatory tightrope BlackRock has to walk. Operating in over 100 countries means they have a target on their back from almost every regulatory body on the planet.
Scale is absolutely a double-edged sword. When you manage the equivalent of the gross domestic product of several large nations combined, you are no longer just participating in the financial system.
Right.
Your actions, your algorithms, and your capital allocations impact the stability of the system itself. Regulators globally are acutely aware of this systemic importance.
The 10K outlines some very specific, intense regulatory headwinds they are currently facing. First, there are global money market fund, or MMF, reforms. Following recent periods of market stress, authorities in the US, the UK, and the EU are pushing for higher liquidity requirements.
Regulators are pushing for macroprudential liquidity rules, essentially forcing these money market funds to keep significantly more cash and easily sellable assets on hand.
Just in case.
The goal is to ensure they don't collapse if everyone tries to withdraw their money at once during a panic.
Then you have antitrust scrutiny. The FTC and the Department of Justice have approved major amendments to the Hart-Scott-Rodino, or HSR, rules. These amendments require vastly more information to be reported before companies can legally merge, which significantly increases costs and delays transactions.
Yeah, slowing down the M&A pipeline.
On the global tax front, BlackRock is navigating the OECD Pillar 2 framework, which establishes a 15% global minimum tax for large multinational companies.
And that framework alone requires a small army of accountants and tax lawyers to navigate. Different sovereign nations are implementing those tax laws at different speeds, and often with slight, highly complex local variations.
Exactly. And then there is the incredibly complex landscape of global sustainability regulations. Now, looking strictly at what is reported in the source material today, and without taking any political stance on the merit or the drawbacks of these laws, BlackRock is facing an absolute labyrinth of compliance.
It's a patchwork.
In Europe, they have the EU's SFDR 2.0, which proposes to heavily revise how financial products disclose their sustainability impacts, aiming to simplify product-level disclosures and introduce brand new products categories. In the U.S., you have California's climate disclosure laws, such as SB 261, which requires certain climate-related financial reporting, though the filing explicitly notes this is currently facing active litigation.
Right.
Globally, they're also adapting to new disclosure standards from the International Sustainability Standards Board, or ISSB, which are being adopted by jurisdictions ranging from Japan to Canada to Mexico. Again, we aren't endorsing or critiquing the politics of these rules. We are simply reporting that for a firm operating at BlackRock scale, tracking, interpreting, and complying with this shifting global mosaic is a monumental operational task.
The key takeaway for you listening right now and wondering how this impacts your wallet is the concept of fragmentation risk.
Fragmentation risk.
Right. When a massive financial institution operates in over 100 countries, conflicting local regulations create immense legal and compliance friction. You might have the European Union demanding one specific type of disclosure for a fund, while certain U.S. states might actively restrict or penalize that exact same metric.
So they are caught in the middle.
This isn't just an abstract headache for BlackRock's compliance department. A change in a tax law in the EU, or a new macroprudential liquidity rule in the UK regarding money market funds, can directly impact the performance, the fee structures, and the underlying holdings of the mutual funds or ETFs you currently hold in your own retirement portfolio.
It all filters down.
The immense cost and friction of global compliance eventually trickles down to the end investor in the form of structural changes to their everyday investments.
It really makes you realize that managing $14 trillion isn't just about picking the right tech stocks or timing the bond market. It is about navigating a geopolitical, technological, and legal minefield every single day.
Which leaves us with a final thought to mull over as we wrap up. As BlackRock surpasses $14 trillion in assets under management, while simultaneously embedding its Aladdin risk management technology into the daily operations of global banks, insurers, and even its own rival asset managers.
Yeah.
At what point does an asset management firm cease to be just a massive participant in the market and essentially become the infrastructure of the market itself?
It was a Revenue Radio podcast. Thank you for watching. Please like, subscribe, and hit the bell to stay updated with our latest analyses.